They didn't hit silver on a quiet day. They didn't hit it when nobody was watching. They waited for a moment the world couldn't ignore, because Venezuela isn't just oil anymore, it's a fuse. And the second that fuse lit, silver did what silver always does, and it didn't walk, it lunged. As this story breaks, spot silver has been ripping, up more than 5% in a session to around 80 plus. That's not normal volatility. That's the market screaming that risk is back, and liquidity is thin. And now, right when the crowd is staring at the candles, Bank of America drops a number that sounds insane. 309. Not tomorrow, not this week, but as the end game math, if the system keeps breaking the way it's breaking. This video is the bridge between those two worlds. The Venezuela shock that just pushed silver back above $80, and the Bank of America path that ends at triple digits, up to $135 to $309 in their extreme scenario framing. So don't blink, because what's happening isn't random, it's a sequence. In the next few minutes, we're going to break this into 4 parts. What actually changed in Venezuela, and why markets instantly priced fear. Why silver moves harder than gold, and why $80 isn't the top, it's a signal. Reuters, the BofA's $309 math. What it depends on, and what has to happen for that door to open. Your battle map, key levels, paper versus physical. And what would confirm this move is the start of a new leg. Not financial advice. This is market mechanics. Let's get into it. Why Venezuela lit the match. Here's the part people miss. Markets don't panic because a headline is dramatic. Markets panic when a headline implies duration. Not a one-day scare, a new regime. And what happened around Venezuela is not being treated like a short-term incident. Reports this week describe a major escalation. U.S. forces captured Nicolas Maduro, and the fallout has been immediate. On top of that, Reuters reporting points to the U.S. posture shifting into something far more structural. Talk of oil transfers and control language that signals this isn't over. Now, you don't have to take a political position to understand the market reaction. All you have to ask is, what happens when the world thinks a region is entering an unstable corridor? 2 things. A. Safe haven. Flows wake up. Gold moves first, then silver, because silver is the smaller room with the same number of people running for the exit. And that's exactly what we saw. Reuters noted safe haven demand lifting gold, and in the same move, silver surged, up to about 80.68 in that session. Reuters, B. The insurance premium shows up in commodities. Even when the metal isn't physically mined in Venezuela, conflict changes. Shipping insurance financing conditions, counterparty risk, and the cost of holding real assets versus promises. The market starts paying a premium for things you can touch. That's the first bridge between Venezuela and silver. But the bigger bridge is this. Silver isn't only a safe haven, it's a strategic input. So when geopolitics shifts, silver gets hit from both sides. Investors buy it like protection industry buys it because supply chains don't wait for speeches. That's how you get violent upside. Part 2. Why silver blows past $80, $430, $810. Let me say it clean. When gold moves 1%, silver doesn't politely follow. Silver overreacts. Silver overshoots. Silver is the market's lie detector for stress. We just watched silver rip back above $80 again, while gold climbed toward record territory. And remember, silver already proved it can move like a wild animal. Reuters documented the all-time high around 83.62 recently. So the question isn't, can it reach $80? It's already there. The real question is, was $80 a ceiling or a checkpoint? Here's the mechanic. 1. Silver is a smaller market, less liquidity, bigger moves. 2. Silver has 2 engines, gold has 1 engine, monetary fear. Silver has 2, monetary fear, industrial necessity. When both engines fire together, you don't get a gentle rally, you get a gap move. 3. The market is pricing regime change, not event risk. That's the key. Event risk fades. Regime change compounds. And if the market believes 2026 is going to be a year where geopolitical shock as normal supply chains are politicized and real assets become strategic, then silver doesn't need permission. It just reprices. Now, this is where Bank of America's $309 headline enters the room, because BofA's didn't pull $309 out of thin air. They built it on a ratio. The BofA's $309 path. Let's talk about the number that makes people laugh. Bank of America, via Metals research commentary widely circulated this week, frames silver's extreme upside using the gold to silver ratio, saying silver could potentially peak between $135 and $309 under ratio reversion scenarios. That's not a tomorrow forecast. It's a math door, a door that opens if the ratio compresses hard. What is the gold-silver ratio? It's simple. Gold price, silver price, action ratio. If gold is $4,500 and silver is $75, the ratio is 60. When the world is calm, the ratio tends to be higher. When the world is in a commodity stress cycle, the ratio compresses, sometimes violently. And BofA's framing references historical extremes, ratio lows like month 32 in modern history, and far more extreme compression in older spikes, the famous 1980 blow-off. Those ratio points are what generate the $135–$309 range. Now here's the important part. BofA's $309 is not silver demand grows 10%. It's the market stops pricing silver like a normal commodity. It becomes a strategic, monetary industrial hybrid where scarcity and fear collide. And what does Venezuela do? Venezuela increases the odds of higher gold, higher geopolitical risk, and policy-driven commodity nationalism that's ratio compression fuel. Why the ratio matters right now, because Bank of America has also been publicly bullish on gold itself, raising its gold forecast toward $5,000 in 2026 in prior guidance. So if gold stays elevated or goes higher and the ratio compresses, silver doesn't have to work hard to hit triple digits. It just has to stop being capped by paper pricing while physical reality tightens. That's the thesis. Not silver to $309 because vibes. Silver to triple digits because gold is elevated, monetary fear persists, industrial demand doesn't pause, and the ratio compresses as capital crowds into real assets. Now let's bring it back to the tape. We're over $80 again. We've already printed 83 plazas recently. So what comes next? You don't predict the endgame first, you map the steps. The battle map. Levels, signals, confirmation. A. The three levels that matter. 1. $80. Psychological plus headline level. If silver holds above $80, it tells you something simple. Buyers are not tourists. They're building positions. 2. 83.62 area, the recent all-time high zone. This is the line where the market flips from recovery rally, price discovery. 3. The next psychological shelf, $90, $100, $90 is where disbelief turns into headlines. $100 is where the public finally shows up late. B. What would confirm this move is real? You're looking for confirmation signals, not hope. Here are the signals. Gold stays firm while silver stays firm. That says risk premium is persistent, not a one-day trade. Silver breaks the ATH zone and doesn't immediately collapse. Volatility compresses at higher prices. If silver starts chopping above $80 instead of whipping back to the low 70s, that's a base. Physical premiums don't fall with spot. When paper dips but physical stays bid, that's the tell. C. The bank game, what they'll try next. If you've watched this market long enough, you know the pattern. When silver runs, the system tries to shake weak hands out, trigger stop losses, and make the breakout look fake. But here's the problem for them in 2026. Silver has become too visible, too strategic, too politicized, and Venezuela is gasoline on that process because it keeps fear elevated. The big connector. Let me tie the bow. Venezuela is a geopolitical stressor that lifts gold and silver through safe haven demand. Bank of America's $309 is a ratio compression endgame that requires a world where fear plus scarcity compress the gold to silver ratio. So the story is not Venezuela means silver goes up today. The story is Venezuela is one more event that pushes us into the type of regime where BofA's ratio math stops sounding crazy, not guaranteed, but structurally plausible. And that's why silver above $80 isn't the climax. It's the opening scene. Here's what I want you to remember. Price is emotional. Structure is mechanical. Today's silver move, back above $80, was the market telling you risk is rising again. And the BofA $135–$309 framework is the market telling you what can happen if the ratio compresses in a real scarcity cycle. So don't anchor on a number. Anchor on the sequence. Geopolitical stress, higher gold ratio compression, silver repricing. If we break the $83 zone and hold, the market is not rallying. It's redefining the metal. If you want part 2, I'll map the next upside pathway, what $90 would mean, what $100 would trigger, and the exact conditions that would make the $135 door start to look realistic. Drop a comment. Do you think silver is still a commodity, or has it crossed into strategic asset territory? Like, subscribe and stay sharp. Disclaimer, this is educational commentary, not financial advice.